just to set the context right, today with us we have Shankar sir, Deepak, and Yash. The theme or agenda here is investing in 2022. I would like now to request Yash to probably take the lead here and go ahead with it.
Hey, thanks, Saksham, for that. And good evening and welcome, guys. Thank you, Shankar, first of all, for agreeing to do this. And joining me, obviously, is Deepak as well. So before we start, I'll just give a quick intro of Stockwits. So for all those who don't know, Stockwits is the OG social platform for investors and traders. Our mission is to basically empower retail investors to become sharper and become the platform that hosts global conversations across assets, be it stocks, cryptos, NFTs, different trading styles, and experience levels. We recently raised $13 million in a Series B funding round from FTX, which is one of the largest crypto exchanges in the world, and TimesBridge, which is the venture capital arm of the Times Group, with whom we have a strategic partnership to help us in our mission for the Indian market. So, as I was saying, I'll just quickly introduce the panel for today's session. So, I'm joined by Deepak Ajwani. He is the editor at ET Digital and our good friend and well-wisher, obviously, Shankar Sharma. He's a legend and needs no introduction. Thank you so much, guys, and we'll start with the spaces now. All right, so I'll go first, Shankar. So let's start with the top-down view of markets and all that's happening globally. Right from the Fed raising interest rates, Russia, Ukraine tensions, crude is at a 9-year high. The headlines are absolutely brutal. What's your take, and how are you navigating the markets at this current juncture?
So, first and foremost, let me make one thing clear. None of this should surprise us. First, and if you are a, if you're basically somebody who believes in data, okay. And can you guys hear me? Am I loud and clear?
Yep.
Okay. The data was very, very clear even last year, and the data was that over 100-year period when we analyzed markets, and this is back in May or June last year when we were running the numbers. Okay. Over 100-year period, we looked at market returns. And what we found was that once you have 2 years of positive returns, 2 consecutive years of positive returns, the third year getting a positive return year, being a positive return year, the probability is 50%. Okay. Which is okay. We understand that it can be either up or down. But the moment you have 3 up years in a row, then the probability of a fourth up year in a row declines to almost zero. That is very, very telling data. Now 2019 was a up year for global markets. 20 was a up year. 21 was an up year. So therefore, statistically, at least I was very clear that 2022 is going to be a difficult year just because the data on a long-term 100-year history basis is more likely to be right than the emotions of all of us who believe that markets can only go up and they should never go down. And with that view, at least I was clear that let us not be as aggressive going into 2022 as we might have been in 2020, 21, and therefore all these headlines you're talking about are not something which have just come out of thin air. These headlines in a strong first year bull market will be shrugged off. Go back to 2003-4. Okay. In 2003-4, we had a huge upsurge in commodity prices, right? I think if I'm not mistaken, oil was up some 50-70% between 2003 and 2004. And gold was up, every single commodity, copper was up. Yet markets just went on rallying like crazy for 4 years. People said commodity prices don't matter. What is the problem with high commodity prices? But they matter. They don't matter when the bull market is young. They matter when the bull market is aging. So 3 up years in a row meant that the bull was already a tired bull, and all it required was a bit of the matadors strategically place needle on the shoulder to bring it down. It's not dead, but at least it's on its knees. That is the whole way to look at the markets. The same piece of news 2 years back would not have mattered. The markets would have shrugged it off because the bull was nice, young, strong, said, man, it doesn't matter, we'll all overcome it. 3 years on, fourth year of huge running, the bull is tired. And a tired bull is more likely to go down with just a little bit of prodding by the matador. That's exactly what this problem is, if we can call it even a problem. If you're a long term observer of markets, you should be not surprised at this at all.
Shankar, if I can come in here. So if the bull is tired, should the Indian investor also take some rest? Book profits, sit tight on the cash or park it in debt, and then come back when the bull is ready to roar back?
So here is my take on this. First and foremost, this is a very good situation that has happened in markets, particularly in Indian markets, where investing is still a very, very new thing. Uh, Even though markets have been around 100 years, Indian investors are still not mature enough to understand the risk and the reward of equity investing. All they believe in is that markets can only go up and they never go down, and the risk is virtually zero that you will lose big money. Particularly last 2 years, 2.5 years, many youngsters have come and taught me many things about stock market, that I'm an idiot and I don't understand this. And I say, we will see. I used to be like that. I'm much older, much wiser now. The reality is that you cannot put 100 rupees of your entire investable surplus into equities. That is never a good idea. In all events, in all situations, equity should not be more than 70% of your net worth, of your liquid disposable net worth. They should be no more than 70. In fact, if you are probably in the middle ages, you should be more like 60. If you're very young, you can take a bit of more risk, maybe 75, but it should hover around the 70% mark. The rest of it should anyway get allocated to fixed income, maybe some gold, maybe some real estate. That's all different, but definitely not 100% equities. So this market is also a great classroom. It teaches you things which otherwise you would never learn reading a book. When you put money, lose money, then you realize, shit, I should have been a little bit more conservative. So to answer your question, what should investors do? First and foremost, what they should not do and what they should not have done is to go and buy junk companies being sold by venture capitalists at crazy valuations. If you bought that, I think you're the biggest fool in the world and you deserve no sympathy at all. But if you are moderately intelligent, there are any number of bargains in the market right now in the small cap space. I mean, I tweeted about it and I believe it. I meet companies, they're 5 times, 7 times, 8 times earnings, good visibility for the next 12 months' time, good sectors. There are any number of opportunities. So there's no need to panic. There's need to choose wisely. In a downturn, your choices have to be more refined than in an upturn. In an upturn, just about everything goes up. In a downturn, you will still make money, except that you will not make money with 100 different stocks. The number of stocks that will make you money will come down dramatically. Therefore, the need for skill goes up. And if you're skillful, this is a great market for you.
Right. So, to summarize for those who've just joined in, what you're saying is it's not the time to rest, but be wise, dig deeper into data, and then take your bets, but not necessarily completely chill and relax. Great. Thanks a lot. Let me come to the next question that we had thought of. Sticking to the global theme, because we can't be completely decoupled, especially with the Fed sort of putting in so much spanner in the works for Indian markets. The Nasdaq has been on a secular uptrend since the global financial crisis. But recent moves, especially in the tech stocks, Facebook, Snapchat, Peloton, they are getting scary. What is your view on the tech stocks and how much of it will impact thereby on the Indian market?
So India is not a tech-driven market in the first place. So the impact directly from a Nasdaq fall, it has some effect, but not like a huge amount of effect, because India doesn't have any tech companies. India has only IT services companies, and their dynamics are completely different from that of a Peloton or even that of a Facebook. They are more like old line manufacturing companies, except that they have bodies manufacturing the services instead of factories manufacturing the services, and therefore their volatility is a lot lower than the companies in the US. For the US investors or for the US centric investors, all these companies, the Pelotons, and you are talking Facebook, but leave Facebook aside for a minute. I mean, I invest, extensively in the US. I can tell you the carnage in the US has been of unbelievable proportions, which the NASDAQ index does not show you. That's because it is driven by Apple and Microsoft, and of course, Facebook too, Amazon, which, one or two have fallen, but not as much. It's a very, very top heavy market, but the bottom of the market has been crushed. I mean, stocks are down 90%, 95%. IPOs that IPO'd at 8 billion, 10 billion, 15 billion market caps are now $500 million. The thing about India is that we don't watch all this, and none of the channels show all this because it's too scary for us Indians to realize what kind of global carnage has happened in tech. We are looking at a 50% fall in Zomato and Nykaa and saying this, that's a fall. You have no idea how much US stocks of similar kinds with poor fundamentals and crazy valuations have fallen just in the last 6 months time. And therefore I call our Indian tech, or so-called the new age companies, although they are basically old economy companies with an app. I think they can just keep halving from these levels. If the US tech experience is anything to go by, those companies halved and then halved again and then halved again just in the last 6-8 months time. Peloton was $170, I think. DocuSign was $200. They are down 80%. I mean, so what are we getting scared about in India? We haven't seen anything yet for similar companies.
All right. So if new age, or if these new age businesses are just old economy companies with apps, then probably Peloton is just a treadmill with an iPad stuck on it. But let's move the conversation forward and let's
Correct.
talk about cryptos and NFTs, right? So the past year was huge for cryptos and NFTs actually going mainstream. And same time last year, we were going through one of the biggest rallies in any asset class ever. But the momentum has sort of faded recently. Despite the 30% steep tax, the future of crypto currently still hangs in the balance. What is your view on the space, Shankar? Are you a believer, or like most famous investors, you think it's going to zero?
No, no, no. I'm not of that camp at all. I believe it's an asset which has legs. Now, whether it gives you money or returns or not, that's a different discussion. But is it going to go to zero or fade away and get over? Forget it. I mean, then you are really seriously over the hill if you believe that. So I do not believe that at all. It's a genuine asset class now, except that the volatility that it has means that for me as an investor, at the best of times, I would never want to have more than 2 or 3% of my net worth into cryptos. That's the maximum I would ever risk on this asset class till it matures into a relatively more, let's say stable and a more robust asset class. Right now, a tweet by some automaker, CEO in the US can send it down 10-20%. I mean, that's ridiculous. How can my assets be dependent on what one guy's view of one particular asset class is, particularly whether he's an expert investor in that asset class or not itself is a big question mark. So it's not as if he's the Warren Buffett of crypto. So I mean, with those characteristics, it is not something you want to put 40%, 50% net worth in. Couple of percent here or there, I think definitely, without any doubt.
Hi, Shankar. The next one from me. A lot of our stock Twitch followers, ET markets followers are first-time investors, and there's one question that we keep getting repeatedly. From here on, how's the markets headed? Are we, you know, in a reality where technically it's not even more than 10% down from that all-time high? But you said the bulls are tired. How long should this resting period be? Uh, and is it down to purely poor expectation management after the splendid 2 to 3 years that we've had? Or you think that this might take longer to recover?
Okay, so let me give the answer in two ways. Number one, as I said that this bull has run long, hard, delivered us fabulous returns for the last 2.5 years in India, 3 years globally. It is about time we gave this bull a bit of rest. I mean, let's face it, guys. You can't run even 5 kilometers without taking a rest, and you expect the stock market to keep running permanently upward. I mean, how on earth is that even possible? So, as seasoned investors, We expect this, we welcome it, because that is the time when you will get amazing bargains. That is number one. Number two, if you look at Indian market, the Nifty dominates, the Nifty or Sensex dominates in terms of market cap. And that's exactly where the problem lies. And I have said this publicly many times, that banks and financials are not the place where I want to be. And I mean, fortunately, luckily, more than fortunately, I've been right on this. They have done nothing at all for 2 years. HDFC Bank stuck at 1400, 1500, Kotak Bank 18, 2000. RBL, obviously, pretty significant disaster. Axis Bank has been, I think, flat for 5 years now. So the bank Nifty has done nothing, and the banks individually have done nothing. The halo or private sector banks for the last 2.5 years. That's 40% of the market. Then you have the FMCGs. Again, I've had a very, very negative view on them. They have gone nowhere. Lever, Asian Paint, Britannia, Nestle, etc., etc. And then you have Reliance, which had a big move after the Facebook and Google investments. From 1300 went to 2400, and that all that happened in the matter of, I think, 2 months time. And since then it has flatlined. So there you have nearly 60% of the Sensex or the Nifty, or maybe even 65%. I don't see how these companies can give you 20% compounded stock returns in the future. I just don't see it. It's not possible for that, for this set 60-65% to give you that. So that leaves all the heavy lifting with the 30-35%. Now, in that you have companies like Eicher Motors, or like, I think maybe Maruti or something. Again, autos are not this place you're going to make 20-25% compounded. So add another 5%. That's 70% of the Nifty. What you're left with is basically the IT services companies, and those horses are going to run. So therefore, 30% or maybe 20% will run well. 70% is not going to go anywhere. 5% is going to be tepid. The Sensex or the headline Nifty returns are not going to be anything much, which drives me to the point that it is going to be the small cap end of the market where you are going to make significant money. I don't even waste time looking at the price of Hindustan Lever or HDFC Bank. If you ask me what it was in the last 1 week, I don't even know. I don't even care. Those are best before date stocks. They're past it in terms of, I'm not saying they're going to fall or they're bad companies, they're great companies, but they're not great stocks. So therefore, small caps, great value. I think you will make significant money even in a down market, buying a handful of 10, 15, 20 well-chosen small cap names. I see plenty of choices on the table right now.
I have a follow-up question. I mean, you are quite bullish on the small caps, but for the uninitiated, what exactly should they be looking for? What are the signals that they should be looking for in the set of small caps available today?
So what they should be looking for is that, first of all, whether there's adequate trading volume in the stock or not, because in a lot of these stocks, there is hardly any trading, and which means that they're always risky in terms of entries and exits. And that's usually a problem in this space, because obviously, if you buy something, there is always a negative. So you can exit HDFC Bank at the press of a button, but it's not going to make you money. You're going to make money in a small cap, but you may or may not be able to exit that easily. So trading liquidity is extremely important. Keep an eye on that. Other than that, the realities of small caps are that uh, most of them are very dodgy. Okay, I want to say this very clearly. You have this literally a needle in the haystack, which is why for most small investors, it becomes a very difficult thing to do, because obviously management access won't be there. You will not be able to reach companies or CEOs and all that. You can attend conference calls, but that's about it. It is a difficult area of the market, which is why I said that this year is going to be difficult, because you will still make money, but you'll have to work harder to make that money, instead of a broad bull market when you just show up and you will make 25%. This is not going to be that kind of market, but still, you will get opportunities. Small investors, if again they run good screeners, if they're basically well educated in finance, I think they will find 20 good stocks. I'm 100% sure of that.
All right. Shankar, you've rated the budget a solid A plus, and you remain optimistic about the economic recovery and pickup in capex cycle. So in that context, you mentioned about sectors like banks, FMCG, where you don't see that sort of an upside. In that context, what do you like for the rest of 2022?
So like I said, I like chemicals. I like companies that are playing the EV theme. I'm not saying they're making the vehicles, but there are inputs to the vehicles. There are many smallish companies in India which have got some products which supply to the EV or cater to the EV markets. Those are good places. Companies that are based that are driven by let's say cleaning up the environment. I think that's a big theme. There are a couple of unlisted companies I'm looking at in that space. Not that many listed names, but hopefully that segment will grow too, because clean energy, clean tech, environment are going to be huge themes for India, which has never paid any attention to it. India remains one of the most polluted countries in the world, which means that that is exactly where the opportunity is. And of course, there will be manufacturing plays coming out of the PLI schemes. Indian telecom manufacturers, I've liked them. I own a few of them. They've done very well. So there are plenty of choices, to be honest with you. I have more choices than I have capital.
I'll take the next one, Shankar. You know, FIIs come in, they put in the money, they want to make a good, quick buck on the Indian market. Something happens, they pull out the money. And this cycle has happened many times. In the last few years, though, DIIs have sort of kept on pumping in the money. The SIP money keeps coming in. Indian retail investors seems to be quite optimistic or maybe left with not much of choices to park money elsewhere. You think the time will soon come out that we won't be dependent on too much on FIIs or FPIs putting in and parking their money in the Indian market, but the retail investor, the DIIs, the MFIs will sort of hold up the Indian market?
Oh, absolutely. I completely buy that theory. When I started my career in 1990, or 89 actually, I'm in the stock market. I kept hearing that India had very little household savings in the equity markets. It was, I think, 0.5% or something at that time. Then the number grew to 4%, and we kept believing that this story one day would come true when Indians would really start investing in the stock market in big numbers. Uh, but that took a long time coming, and that happened only in like 2020 when demat accounts really went up 5x, 5 crore new additions and all that. So, the story took a long time coming, but it has come. I think it's here to stay. I also like the fact that a lot of the small investors are not idiots. Okay, there might be a few who invested in the Zomatos and Nykas of the world, but that's there. We also make a lot of mistakes, despite having been around for 30 years. So not to blame them, but most of them are fairly intelligent. They look at the data. They are educating themselves. Online education is big now in investing, so they have much better tools to invest, and which is why I'm bullish that they will provide the necessary support to markets. Uh, when FPIs pull out, and FPIs. I mean, I've known FII fund managers for decades. Many of them are very dear friends. They have themselves no clue about what flows they are going to get, because they are also intermediaries. People think it's their money. No, it's not. It's the money of the potato farmer in Iowa who's giving the money to some pension fund. The pension fund is allocating to some fund manager in Asia or wherever. Then he's allocating to some fund manager in India, and then the Indian guy goes and buys. But then there is a redemption. It doesn't mean that this fund manager is redeeming. It is that the potato farmer wants some of his money back, or the pension fund wants it back. So the chain is pretty long in all this. There are all kinds of intermediaries in the middle. The FPI money is not really the decision of the FII fund manager to sell. Understand that basic fact. Somebody sitting in Singapore doesn't make those decisions. It's the guy sitting in the US who's farming that corn who's making that decision, or the asset allocator is making that decision, sitting in these endowments or pension funds which control the flow of money. So the fact of the matter is that this is always going to be a volatile source of money. We all know that. Indian investors, because of financial repression, they, as you correctly said, no options. So I think it's a great thing that they have now come out and decided to invest in a significant way, and that will provide a lot of floor to this market.
I'll take in the next question, Shankar. So 2021 has been the year for IPOs. We can go on and on about the names like Zomato, Nykaa, Paytm setting the ball rolling, but obviously they've sold off, like Zomato today falling below its IPO price. At what valuations or at what levels do you give these companies a fresh look? And also, which of the last year's IPOs, which companies stood out for you amongst the pack?
They all stood out in that they all were brilliant IPOs. I mean, again, let me make one thing very clear. I think Zomato or Nykaa or I don't know Cars 24 or whatever other stocks that went public and sold their stock and got oversubscribed and got exits and OFSs for the VCs or promoters or whatever. I think I doff my hat to them. They did a fantastic job. I mean, it was a flawless performance, slickly marketed, superbly executed, and executed, I say, in a positive way, not executed as in killing investors. You can interpret it that way also, but that's not what I actually mean. So, so hey, it's their job to sell stock at high valuations and overprice it. That's the job of investment bankers and companies. If dumb idiots go out and buy them, it's their fault because it always buyer beware. So I have no interest in looking at these companies because their business models are all rubbish. There is nothing proprietary or business wise any edge that they have in this business. Okay, understand this. Everybody keeps talking about one Amazon which survived and went on to become a whatever $2 trillion company out of the wreckage of hundreds of such companies in the dot-com bust. Hundreds, maybe thousands. We look at one survivor and we say, wow, look, that is the potential of the internet. But we forget that is in any game, there will be one survivor. You can smoke cigarettes, 60 cigarettes a day, and one guy out of a million will live to be 100 years. Are you going to say the smoking cigarettes doesn't kill you? Of course it kills you, except that one guy is not going to die. So that one guy was Amazon. So the reality is Amazon survived because it has AWS. It has nothing to do with the e-commerce business, which was a loss-making business for years and decades. Which is these companies AWS? Nothing. They're commodity producers. They give you cash and discounts and freebies to lure them in. Moment they cut that, the business goes away. So what's the rocket science in this? They're just a bunch of old economy business with an app and a website. App is new. In 2000, they used to have a website to get these valuations. Now you need an app. They have it. Selling a lipstick. I mean, tomorrow Jio will do that, and I believe they're going to do that. Tata's will do it. What's the big deal in selling lipstick and cosmetics or food delivery? I mean, if Jio can deliver rice and dal to your home, they will start delivering food also, if and only if the valuation sustain for Zomato. If valuations collapse, Reliance will say not worth it. If valuations sustain, you will get more competition because who doesn't want 75,000 crores of market cap? So these businesses are not worth looking at. We will look at businesses that have some edge. What is the edge to these businesses? Tomorrow Swiggy will come down and start giving you 50% cash back. So you'll go to Swiggy. Do I care whether I order on Swiggy or on Zomato? I don't.
But Shankar, while there's cash burn happening in these valuation rich
Why are you
companies.
guys looking so serious here?
Okay. No.
Am I sounding so depressing?
You almost sounded like a very brutal shark there.
You talked
We at
about
least don't have any doglapan here, Yash. So just on a lighter note.
the reason why I ask you, Shankar, is that these valuation rich companies did put out of business the likes of Kishore Biani and some others, right? I mean, the modern trade stores, so to say. So while they're burning cash, they're doing the app and the valuation game. The brick and mortar players, the serious players, the hardcore balance sheet, EBITDA players are running out of cash and business together. So how long can this continue? Because it's damaging to the others.
That is true, which is always the case, that I have a perfectly good business and here comes an idiot with a lot of VC money and no clue, but he has an app. मेरे पास app नहीं है. And he comes and kills me. Such is life, man. I mean, come on. That is reality. So, Kishore Biani is a very dear friend of mine, but all I can say is that, what can he do when his competition is irrational? When your competition is irrational, there is very little that you as a promoter who is focused on doing things the right way can do. I mean, that's the unfortunate. This is a jungle raj here, or let's say law of the jungle, survivor of the richest. So the guy with the more money will not survive, but at least he will survive long enough to put you out of business, which is what is exactly right, which has happened.
So you reckon the Tatas are getting together to put their app? Jio is already there. They've taken Milk Basket. So they too will already have a JioMart app. So the better valuation or the better business sense app will beat the valuation rich apps?
100%. They will not have, I'm not saying they necessarily will have better business sense. So I don't credit big Indian companies with a lot of sense either. All I'm saying is that these irrational cash burning business models, okay, they have put out somebody else out of business. They put somebody else out of business, but they themselves, because they have put somebody else out of business, they will get put out of business, or at least, if not all the way down to zero, they will run into trouble because their market caps for this irrationality is so attractive that even I'm tempted to start a super app selling lipstick and doing food delivery. क्या रॉकेट साइंस है इसमें यार? ऐप ही बनाना है ना बॉस. उसके बाद 100 crore रुपया रेस करो, डिजिटल मार्केटिंग करो. अगर नाइका सेल्स लिपस्टिक, आई डोंट नो व्हाट अ लिपस्टिक सेल्स फॉर, आई नेवर यूज्ड इट इन माय लाइफ, बट लेट्स से सेल्स फॉर बड़े 200 रुपीस, मैं 50 रुपए का बेचूंगा यार. If I sell below cost something, I will have unlimited demand. We know that, right? If mobile phone is $1,000 and I sell the same mobile phone for $50, I'll have probably out of 600 crore human beings, I'll have at least 100 crore customers, no? Who will not buy my mobile phone? Same thing, 1000 का मैं 50 रुपए में बेचता हूं, तो मेरे को VC मनी मिल गया 950 को फंड करने के लिए. तो अभी वो VC मनी वाला जो गेम था, because of money tightening, will become harder and harder to raise, which will give an edge to your old line company Reliance and Tata to come and spoil the party for these guys.
Okay. So watch out for Fed. Thanks. I'll
Deepak,
come to the next.
before you start with your question, guys, do comment any startup names if you have any suggestions for Shankar, because like he said, he doesn't mind starting one of his own. So comment below any startup name suggestions that you have for Shankar and his new business. But over to you, Deepak.
Shark.com.
But he's sure he won't sell lipstick, so give ideas accordingly. Fair enough.
नहीं
For
नहीं,
groceries and
boss,
mobile
for $1 billion, I will sell, even my soiled pajamas, man. Come on. Why not, yeah? It's a
Great,
month game. It's a simple game, right? Sell something below cost, create unlimited demand for that below cost model, fund the difference with VC money, and you are well on your way to 10 billion market cap. Sell your stock in the OFS. You have as a promoter 6%, 3% of the company, and the rest is owned by God knows who. That's the simple, I mean, five-point game. No rocket science.
धनबाद का आदमी धंधा जानता है, आप बस आइडिया बताओ. Fair enough. Okay, yesterday we had inflation numbers come tad above, what the RBI had said, 4 to 6. So it sort of breached sort of a bit. But should inflation be a concern for the investors? Because what would you say about the connection of inflation impacting the margins of the company and thereby their results and their earnings, which will, of course, eventually translate into their stock price? How concerned should the investor be about the inflation? Because RBI seems it's okay.
So now there is very divided school of thought on what RBI should do and should not do. My view in general on inflation management by our central bank, the RBI, has been that, and if you look at basic 5-minute analysis of the inflation basket in India and say that if RBI raises rates or decreases rates, does that at all impact the prices of the inflation basket? And we did this analysis a few years back, and there was no correlation. आप interest rate बढ़ाओगे तो दाल का भाव थोड़े कोई आपका घट जाने वाला है यार. Yeah, will you start eating less dal or less chawal? So the composition of the Indian inflation basket is totally impervious and resistant to any changes in monetary policy. So therefore, for the RBI to start believing that it is the Fed and that by raising rates it will cool inflation is actually, it doesn't add up. I'm happier and happier if the RBI does not do anything, because our inflation basket is totally insensitive to interest rates. That is one. Second, our inflation is anyway driven largely by global factors. What is RBI's interest rate policy going to do to oil price or copper price or whatever other price influences Indian inflation? Nothing, zero. So उसका क्या फायदा है? अभी वेस्ट में the model is different, right? Everybody buys things on credit. Credit card का culture है. अभी when you raise rates, you are going to decrease consumption, because people will be more mindful of consuming on their credit cards because the rates are now higher what they're supposed to pay. So therefore you will cool down the economy. Here you will only cool down growth rates without cooling down inflation. That's the essential difference between our macroeconomic structure and the, let's say the US, or let's say the more developed countries, which believe and live where the consumers are highly leveraged. Indian consumers have increased leverage, but not nowhere close to the extent that the US consumer has. So the interest rate sensitivity on their consumption is virtually nothing at all. I mean, if you raise home loans by 1%, you think home demand will come down in India? Nothing. Or car demand will, nothing will change. यार क्या फर्क पड़ता है? EMI 100 रुपए का 110 रुपया हो जाएगा, या 1000 का 1100 रुपया हो जाएगा. Therefore, RBI will be compelled to raise rates, but I don't think it will be a wise move, because they will only end up hurting growth. India today needs growth. If the debate is growth or inflation, I would always say go for growth in a developing country like India, because that's the only way you're going to lift people out of poverty. By decreasing growth and thereby hoping you will decrease inflation, which anyway the equation is non-existent, all you're going to end up is that you will still have inflation with low growth, which is absolutely the worst place you want to be in. That's exactly the mistake Mr. Subba Rao did when he was the RBI governor back in, I think, the early part of last decade. So you killed growth. 2010, 11, 12, 13, we had very bad growth because RBI believed that by raising rates they will cool down inflation. Oh, inflation रह गया, or rates, and growth rate collapsed from 7-8% to 5.5%, which led to the fall of the previous government. So we don't want this government to fall, right? For some reason of this kind. Therefore, inflation and monetary policy in India are not linked at all. Let's hope the RBI doesn't fall for the Western way of thinking. That is one. But the fact is that oil prices and all other commodity prices going up are hurting margins. I speak to companies, they are all getting killed. Wherever there is huge commodity sensitivity, they are getting crushed because end product prices are not easy to pass through. Margins are getting squeezed. Therefore, as investors, we have to be extremely mindful that our company should not have significant commodity raw materials getting into them. That will be a significant problem.
All right. Shankar, this one is not necessarily market specific, but more on your investing style. So a lot of times, we've got questions from viewers that, hey, can you ask Shankar, what are the top 3 things you look for when picking a stock?
So, first and foremost, obviously, the core ratios are the key, because, the one thing that, I've always found is that we get swayed by management speeches and body language. All that is good, but all those typically are very judgmental, very personal to yourself. I might like one management, you may not like it, but numbers are numbers. Usually numbers will be, unless they are cooked up, they will be reasonably accurate reflection of management quality. So focus on numbers, not on the story. I mean, that's really the key. Go down to the basics, drill down to the balance sheet, look at the cash flow. That is very central. We just forget that basic discipline. It's like cricket, right? They get your forward defense and back foot defense first in place before you start to think of playing the fancy cover drives. Because you want to play a long career, you need the defense to be, in perfect shape, because you will need to be solid on that oftentimes. It's the same in investing. They get your defense, and defense is buying really fundamentals that may not be great, but as long as the needle is moving towards goodness, it is a good enough trade. That is one. The other thing I've always believed in is that I don't like buying good quality companies. Okay. So I don't want to buy, I've never bought Hindustan Lever in my life. Okay. Never, ever, not even 100 shares. And thank God I did not. बिकॉज जो अच्छा कंपनी को खरीद के क्या मैं अपने आप को इतना लाइक वॉरेन बफेट ने जाकर एप्पल खरीदा 2016 में बैक 2016 एवरी बूट पॉलिश गाय इन द स्ट्रीट ऑफ न्यूयॉर्क न्यू एप्पल इवन इन बॉम्बे द पान दुकान गाइस न्यू एप्पल इज अ ग्रेट स्टॉक. उसमें क्या बड़ा आपने कर लिया यार. एप्पल आप 2002 में खरीदो ना जाके, जब when the company was close to bankruptcy. Steve Jobs had been written off in his second innings also as a failure. Now he came in 97, 5 years he was floundering, he had no clue what was going on. People say Steve Jobs is useless. एक आईपॉड आ गया उसका, आईपॉड का 2 क्वार्टर का नंबर आया, नंबर स्टार्टेड टू लुक गुड, स्टॉक इज ऑल टाइम लो. आई लुक्ड एट इट एट दैट टाइम, आई रिमेंबर दैट मार्केट कैप वाज लेस देन इन्फोसिस मार्केट कैप. आई सेड यार कि यार बीटन डाउन कंपनी है और ये आईपॉड का इतना इतना मार्जिन बनना चाहिए, व्हाटएवर द नंबर्स वर देन, एटलीस्ट इस प्राइस से डबल तो होगा. आई हैड नो आइडिया इट्स गोना गो अप व्हाटएवर 150 टाइम्स, बट डबलर तो लगता है. तब खरीदो ना. सो आई लाइक टू बाय डेंजर, आई लाइक टू बाय सम रिस्क, आई डोंट लाइक टू बाय सेफ्टी. सेफ्टी के लिए फिक्स डिपॉजिट है ना, सेफ्टी भी क्यों स्टॉक मार्केट में जाना है यार. स्टॉक मार्केट इज मेंट टू बी taken risk with, but take it wisely. It's not blind risk or crazy risk or reckless risk. There is acceptable risk and there is unacceptable risk. Okay, that is the way I look at the market or investing. There are many stocks that are highly risky, like as Zomato is highly risky. Now, could it triple from here? I don't think so, but it might, right? Anything can happen. Am I happy with that risk it poses? I'm not at all happy. It's not acceptable risk. But there are many companies, particularly small caps, which, managements have been, somewhere borderline dodgy, but they're cleaning up their act, they cleaned up the balance sheet, things are looking around. Is that acceptable risk? In my view, yes. As long as I see visibility, 12 months, 15 months tops, I will be a buyer. With the stock price being at near all-time lows, the needle changing from very awful to moderately awful. And that's the other thing in investing. I look for situations which don't have to go from very awful to great. Okay? Like with Apple or Amazon in 2001 and 2002, I had no idea they would there. Even the owners didn't know anything about where they would end up with. The bet was only clear from where it is. Can the needle move to semi-awful? They were awful. They were bankruptcy candidates. That is the first level bet. So a lot of my investing revolves around finding companies which will go from being very awful to being moderately awful. If they become great, hey, then that's a home run. But that's not my starting point, that I think that this will go from 10 rupees to 1000 rupees. I have no crystal ball that tells me 5 years out kya hoga. I have a crystal ball which is good for 12 months. And that's all my analysis runs around a maximum of 12 months of numbers. Nothing beyond that.
Shankar, besides number, you also tend to look at things beyond just the numbers and the psychology. And you famously said in the past that there is no permanent love in equity markets. I know many of us on the spaces are down in some of our favorite positions. There's a very famous FMCG company which has just not moved in like 5, 6, 7 years. There are unlimited memes on it on the internet. As a rule of thumb, when do you say screw it, move on, and take your losses?
Okay, so there is a hard stop of 25% on a position that I have. Anything that hits that position, I'm out. I am not a buyer at lower levels. I never believe in averaging down. I have never averaged down, and I think it's a dumb idea to average down. I will buy the stock again if it goes back higher than my, the original price. Let's say I buy at 100, goes down to 75 or 70, I'm out of the trade. If it goes to 120 and if the 120 move is based on some, say, fundamental changes, quarterly numbers were very good and something really far better than I expected, I'm a buyer of the stock. For me, then it is a new transaction. It's a new bet. I have no memory of the previous one. Where you get trapped is when you have memory. कि यार इसको तो मैंने यार 70 रुपए में मेरा एग्जिट हो गया था, अभी कैसे 120 रुपए में जाके ले लूं. मुझे फर्क नहीं पड़ता है बॉस. How does it matter? If I think it's going to go to 250 at 120, I'm a buyer. Assuming the changes from 70 to 120 are driven by not manipulation, but by some solid fundamental factors or reasons or numbers. So that's the way I look at it. That's my risk management is absolutely central to my heart. I've lost a lot of money being foolish when I was obviously more youthful. I have no desire to lose money in this game. Capital allocation, strict stop losses, position sizing. We all look at, it's like exactly like cricket, right? That we look at the big cover drives as the hallmark of greatness, right? But it's really a solid forward defense sometimes, which is more beautiful than a cover drive. That's the way at least I look at investing. कि बॉस बड़ा लॉस नहीं करना है मार्केट में. If you stay at the wicket, run तो आना ही आना है. But don't get hit wicket or handling the ball and stupid ways to get out. There will be an unplayable ball once in a while, which we cannot handle. That's fine. But at least don't do stupid things. And stupid things will be really bad position sizing, no risk management, averaging on the way down, saying, I still am convinced it's a great company, it will come back. Those are all nonsense and hope trades. That's all hope trade. That's where a rookie and hopefully a professional investor will be separated. That I don't believe in hope trades. Stock price is, wo bata raha hai boss, the trade is wrong, get out of it. That's it.
Shankar, we wanted to stop, but we don't have a hard stop on interesting conversation. So, but keep it to this last one.
Okay.
I'll keep it to the last one. You talk
I
about
hope,
hope trade.
I hope it's not a stop loss, as in you guys have lost all heart.
Hope not. Hope not. So the big hope that the government is wanting to give us all is with the LIC IPO, and government will achieve its disinvestment target by putting out this IPO. What should the retail investor do? Because look, this is a huge cash till which the government controlled and happily used to bail out so many companies, or so many banks, and institutions. The list is too long. Now with retail investor partially in, should the retail investor be still wary because the control and command will still be at the center? So will it be an abuse of your own money, and that's why you shouldn't hope to make much and not even participate in it? Or you think there's still a chance government will wisen up and there's still money to be made on the LIC IPO?
Why are you asking such a long-winded question, यार? सीधा पूछो ना कि
सीधा
सब्सक्राइब.
साधा.
सीधा पूछो ना,
डालूं कि नहीं
सब्सक्राइब करना
डालूं?
चाहिए कि नहीं करना चाहिए यार.
मुझे कॉन्टेक्स्ट और कहानी तो बनानी पड़ेगी ना. So that's what I did.
So the short point here is that, being a participant in India with businesses in India, I have no desire to say to people that do not invest in LIC IPO. Okay, I do not want to belong to that camp, which is a naysayer. I don't want to give an answer to this for the simple reason that either answer is controversial. I just say that, large IPOs are going to be subscribed to more by institutional investors than by retail investors, because institutional investors have a duty to put in money into large IPOs, and very foolishly so at most times across the world, not just in India, because they have such large assets that they can't sit out a large IPO. I have always argued with large fund managers across the world कि क्या ये फालतू large IPO आ रहा है, जो भी उस era का 90s का था, 2000 का था. They said क्या, you don't understand, we also know it is a piece of junk, but डालना पड़ता है boss, there are compulsions, we have to put in. So this IPO will get subscribed to in any case very well, with or without retail investors coming in. For retail investors, it's really their call. If you do believe in LIC, and I think it's a great institution, you put a bit of money, but again, don't do a Zomato type thing that you go and really put a lot of money into it. Some exposure, maybe that's okay.
Yes.
And Shankar, and Shankar, before we let you go, I know Deepak said that that was going to be the last question, but since you gave so many cricketing references, I couldn't hold myself back to asking you that, who could be the Ishan Kishan of 2022? Any stock or sector that could be the Ishan Kishan?
या पहले ये तो बताओ ईशान किशन है कौन?
अरे सर, सबसे
This
सबसे
becomes a
महंगा प्लेयर
पहचान
है
कौन
in
moment.
IPL.
Yeah, I don't watch IPL. If you even remember one word about my whatever I talked about cricket, I talked about a stroke called forward defense, right? When did you
Yeah.
last see a guy do forward defense in IPL, boss? That tells you the era to which I belong.
So let me ask you then to your era. Who are the two probable Dhoni and Tendulkar according to you of 2022 in stocks?
Dhoni and Tendulkar and stocks are going to be uh, hmm, that's a good one, boss. आजकल तो पता नहीं वो मतलब maybe they are also dated. Yeah, now we need guys who are good for one innings, right?
विराट ही बता
So
दो सर.
विराट ही बता दो. I mean, more than stock. So I can tell you the sectors. Chemicals will be the Dhoni. They have been a Dhoni for the last 9 years. Looking at the China plus one, I continue to believe they are still going to be very, very good. There's a cyclical downturn right now, but broadly because of the commodity cycle, crude prices, they're linked to that. The end chemical prices will be strong. I like that, and I like EV suppliers, EV ancillary suppliers, and I like clean tech as I mentioned. So these three are the Virat, the Tendulkar, and the Dhonis because I see these are secular 5-year themes. If not longer than that. And let me say this, okay, as a parting note. When I invest, and that's an important point to just get across to everybody who's caring to listen to this, and I don't really, in such kind of emerging sectors, I don't waste my time looking for individual companies because I have no idea who's going to win, right? So I therefore try and see there are two, three, four companies in the space. वो चारों ही ले लेने का, right? और देखते हैं ना फिर कि यार how who's the guy who's the breakaway in that pack. Usually you'll find one or two breakaways and one or two duds. So you young the duds after 1 or 2 years, and then you're left with the Dhoni and the Tendulkar and the Virat. But you'll start out with a few duds. I don't want to name them. Only then you'll narrow down on those. So basically the trick is get the sector right. That's going to be 70-80% of the battle won in this game. Getting the stock right is a matter of selection after you made your sector selection. And don't do too much micro company selection at the first level. EV ka hai agar acha theme, buy 5-6 companies which are ancillaries or suppliers to the EV theme. Then we'll see who does well. That's the way at least I would like to approach investing for the next 4-5 years because there are a lot of new themes emerging. And I don't know who's going to be the winner, but I know the themes are going to be winners. Like internet was a winner in the last 25 years. Out of that, one or two or 5-10 companies became winners, right? But if you had bought 25, you were left with one Amazon, which itself was enough to make you retire for the rest of your life.
Great. Thanks a lot, Shankar. Thank you so much.
You're
Thank you.
still sounding depressed here.
Sir, koi nahi. Shankar sir, Saksham here. So, guys, everybody listening in, first of all, thank you, Deepak. Thank you, Yash. Thank you, Shankar sir, for having this done. Sir, depressing, काफी market serious बातें हो चुकी है. I would like to let our viewers know कि सर ने एक बहुत ही candid interview भी दिया है हमको with Stockwits and Friend, जहाँ बहुत सारी अनदेखी बातें आप देख सकते हो ना YouTube channel which goes live on Friday. तो प्रॉब्ली सर वो जो क्रिकेट वाली रेफरेंसेस हम बातें कर रहे थे वो ज्यादा निकल के वहां आएंगी.
Correct.
You should have asked him about his food. I've been
मैं
watching his fish pictures from Calcutta. Amazing.
सही में सर यू वर इन कैलकाटा आई वुड हैव लव टू होस्ट यू हियर बट कोई नहीं अगले बार.
अगली बार से चलो done.
बिल्कुल बिल्कुल. थैंक यू सो मच सर फॉर टेकिंग टाइम आउट. थैंक यू दीपक. थैंक यू
Thank you,
यश.
guys. Thank you, everybody.
Thank,
Thank you for listening in.
Thank you
Thank
so
you.
much, Shankar. Thank you,
Bye.
Deepak, for doing this.
thank you all. Thank you, everyone. I
थैंक यू
thoroughly
गाइस.
enjoyed it.
थैंक